Welcome to the daily update, where I'll go over the action in the market for Tuesday, May 21st, and then we'll see how things look for Wednesday, May 22nd. A pretty slow day. On a positive note, we're not really seeing any selling into strength. And anytime we do see a little bit of a pullback, it seems like the buyers come right in and start buying. So things are still maintaining a real positive stance. However, as we look through some of the charts, we're potentially starting to see some weakness come into the market. Now, this could rectify itself quite easily with a solid up day. And some of this is also to do with the way our indicators are calculated. They can't help but start to show some weakness when we're not showing an awful lot of conviction right now. But there are just things that we want to be aware of. Anyway, there were no economic reports that came out. Wednesday, we're going to get a couple of housing type in economic reports that will be coming out. The big thing is going to be the FOMC meeting minutes. They will come out at 2 p.m. Eastern time. It may be a non-event because the market seems to feel like it already knows what the Fed has been saying, but you never know. There might be some little nugget in there or something that the market may react to. Before we get started, please know that I'll be locking down the daily videos starting Monday, June 3rd. That's to give access to people that are members of the program that I'm also starting at that time. And I have some videos. I have a playlist on the YouTube channel, and I have videos on the Rumble channel that talk about the program. And if you have any questions, if you want to talk to me, set up a time to have a back and forth, that would be just fine. But what I'm going to do is right now, when I do these daily videos, they're publicly available right off the bat as soon as I get them posted. Now it's going to be at the end of that trading day. They will then become public after that. About half the people that watch these videos watch them after the market is closed. These videos are really designed to be watched before the market opens. And that's what I want to give an advantage to, since after the market closes, my analysis for that day is kind of out of date. And then we readjust it and see how we look for the next day. If you want to have access to the videos right after I post them, and you don't want to be a member in the program that I have, that will be $19 a month. It is included as part of the membership. The weekly videos will still be available as I post them. That part is not going to change because to me, the daily videos are the real foundation of my analysis. I use all the other videos as more supplemental types of information. If you want to send me an email, here's an email address here at the bottom. I also have the email address right at the end of the video. So feel free to contact me. You can leave a comment. You can send me an email. We can try to set up a time if you want to talk on Zoom or Skype or Messenger or what have you. But just know that that's what will be happening. And I keep announcing this every day until it actually does happen. And I have to click through this. So right at the open, we had a lower open. The futures were actually down a bit. We got down at S1 at 52.99, which you could almost say 5,300. Yeah, it's a flat number. It's a target for a lot of investors. There are a lot of strike prices at this level. So to start out right at that level is not really surprising. But that ended up setting the low for the day. We ended up bouncing up off of that. So we hit the low right at the open. We got above the unchanged level and the daily pivot at 53.13. Then we chopped below and above because we went down to the unchanged level. Then we came back up to the daily pivot. And then we finally broke higher later in the day. That's when things turned a little bit more positive. We closed at R1, which was at 53.21. We were up 0.25%. We're still below average with volume. And this is a classic negative divergence. We're going up with the S&P. We're seeing volume dropping off. And we've been seeing that now for a few weeks. And this is a bit of a concern. We are positive in the short, intermediate, and long term. But as I said, and I'll go through these charts, there's some potential areas of weakness. There's always areas of concern that we need to be focused on. And it's about inflation and interest rates. There's really no economic reports to back that up this week. So it'll be, what did the Fed say during their meeting? And if the markets can get any insight from that, Earnings are kind of what's really driving the market right now, but it's not really having an index-wide impact unless it's something like the Dow, which only has 30 stocks. We're also keeping an eye on the geopolitical concerns in case they escalate and have an impact on the market. Some comments. Mega caps did outperform. They're coming back and showing a little bit more leadership now. That's something that over the weekend I was pointing out that it's a little bit of a warning sign. But for right now, anyway, it looks as though that is starting to rectify itself. And as I stated, earnings are really driving individual stocks as they're still being released. Even though we're beyond the main reporting time, there are still companies that are coming out and companies with influence. For example, Wednesday after the close, NVIDIA will be reporting, and there's a lot of anticipation ahead of that. Our short-term list, we have the Stochk RSI, the Williams percent R, the CCI 14 and 20, stochastics, the slope oscillator, boom indicator based on 20 periods, and the RSI based on 9 periods. These are extreme positive. Right now, it's looking like we're holding at these levels. The list really isn't getting any smaller, and these are pretty much all of our short-term indicators that we look at. So we're just seeing right now that momentum is good. What we're going to be watching for is if we see a pullback, are we going to see selling into strength? Are we going to see a gap lower and then selling after that? If we really start to decline, what is the intensity of that decline? And if we see volume picking up on a decline, that's going to be a warning sign as well. In the intermediate term, a new one, the balance of power is now on the list. The CMB composite, which has been on there for a number of days. The standard deviations chart, we're still in that +3 channel, and that means we're kind of extreme positive. The TTM squeeze, the Chaikin money flow, and then another new one is the money flow index. It's just barely looking extreme. The vortex also starting to look extreme positive. And then our 10-period high-low study that we do on the S&P 500. Long term, we still just have the 150 and 200 period simple moving averages. But as I keep saying, they've been on this list for most, if not all, of 2024. The scenario has not changed. It looks like the Fed's keeping rates higher for longer because inflation hasn't slowed as much as they had hoped to get down to that 2% level. If there are rate cuts, the market is starting to anticipate that it could be in September, but this is going to change every day as economic reports are released, and then will either be confirmed. If the economic reports are weaker, that's going to cause some doubt if the economic reports are stronger. And the thrust up that we saw in late April into May, that is really coming from the Fed decreasing quantitative tapering. The dollar was up and interest rates were down on the day. We fell to 4.41% for the 10-year yield, where we had been at 4.44%. The dollar going up could have put some pressure on stocks going higher. We're still inverted with the yield curves. Sentiment actually ticked down a notch. Yesterday, we were at 64. We ticked down to 63, but we're still positive for the time being. We're still trending now. We're in a developing trend with the ADX, and it's positive because the green line's on top and it's above its moving average. With the slight up day, our bias is positive, and then the last number of days have been up, so our momentum continues to be positive. We didn't have any economic reports, so there's no charts to show. Here's some Isabel Net blog charts. This is Goldman Sachs with their S&P 500 level and earnings per share. This is what they're projecting, and this is their adjusted forecast, and it'll adjust a whole bunch of times, but the takeaway from this is it's continuing to go up, and that justifies higher stock prices. And then they're thinking that we're probably going to be around 5,200. At least that's their estimate for right now as we get closer to the end of 2024. This is another technical analysis chart, but this is on the Dow, and I usually don't show studies like this other than some moving averages and things that we really notice here. But this is looking quite positive because it hit 40,000. The breakouts from a base into a new all-time high in late 2023 and early 2024, respectively, achieved a measured move at 39,300 and favor an upside from 42,600 to 45,200. And it always amazes me when we're more positive, the projections are all rosy and wonderful and looking like we're just going higher. When we're going down, all the projections are doom and gloom. It's just interesting how that works. But there are some levels here and some potential target rates. I don't do an awful lot of target rates. My focus is mostly on the trend and then looking for that resistance along the way. Then this is adjusting for inflation. Equities still have yet to make new highs versus 2021. That's because inflation. We're dealing in an environment now that for 40 years we didn't really have to deal with as much. Now inflation has been a problem. Even though it's coming down, it's still compounding month after month after month. And on a personal level, you're probably really feeling this. And even with the NASDAQ 100, if you adjust it for CPI, we have not set a new all-time high, nor have we with the S&P, the equal weight, or even the small caps. They're not even getting back to an unadjusted high, at least yet. So just something to kind of take into account there. Then looking at the MOVE index and the equal weight index. And what's interesting about this, the kind of brown line here, that's the MOVE index inverted, which is something that I like to keep an eye on. This measures the volatility of bonds. The equal weight is the dark blue line here, where it's been going up, but we're seeing this reading actually going down, and maybe that will give some support to the equal weight index. Then weak small biz credit conditions equal higher unemployment. The dark blue line are the availability of loans, because a lot of companies need to borrow if they're going to expand or even hire new employees or get a new research team in place or a new project management system or something like that. They might have to buy or borrow money in order to get those things. And then we look at that versus initial jobless claims, where the availability of loans has been going down. Is that going to drag down the initial jobless claims? Usually they have a tendency to stick pretty close to each other. Now they're getting a little bit farther apart. Then looking at the economic surprise index, where it's been going down as the S&P has been going up, we're in an era of good news is bad news is good news. And this is being confirmed by what we're seeing on this chart. But that could change. Eventually, bad news is going to get to the point, if it continues, where it will actually be bad news. And good news will actually be good news. And the market goes back and forth all the time between these two. And looking at small caps, this is looking at their ratio with their forward PE ratios as well. And it just shows that on a relative basis, small caps are considered to be inexpensive when you compare them to the large caps, which the small caps is the Russell 2000, the large caps are the Russell 1000. And then this is just comparing the chart that I show, where mine ratio is a little bit different. This is price. This is not forward PE ratios here. The Russell 1000 versus the 2000 shows that the large caps have been outperforming. And I haven't been showing this chart other than the intermarket analysis video update, because we're not doing all that much and we're kind of waiting to see if small caps can get a little bit more strength, but that just has not been happening yet. And then I did find one interesting chart, and this actually wasn't from Twitter. This came from Tom Bowley's daily email that he sends out. And it says in Market Watch, and some of you may be familiar with that. Now they're connected with the Wall Street Journal and Barron's. And this is in a recent article that showed the top analyst year-end targets as of March 25th, and then again on May 20th. We closed after Tuesday at 53.21. Well, BMO Capital thought we were going to be at 5,100, and right now we're above that. And Wells Fargo thought we were going to be a lot lower, as did Morgan Stanley. And JP Morgan really thought we were going to have some problems. Then they readjusted those outlooks to May 20th after Monday, where now they bumped it up at BMO Capital to 5,600. They're also turning more positive at Wells Fargo. Morgan Stanley's also going positive on a 12-month forecast. So they actually look not till the end of the year. They're going a 12 months from now. But JP Morgan hasn't changed. And the takeaway from this is these are professionals. These are what a lot of folks use, and you may use them yourself. And you may turn your portfolio over to some folks from these companies, and this is how they're projecting things. That's why decades ago I decided, if I want to be successful at this, I'm going to learn how to make my own decisions and not rely on somebody else. Because a lot of times these analysts are like weathermen. or weather people. They could say it's going to rain and it sunshines. They say it's going to be sunny and it rains. So where they come up with these, I don't know, but as the market's going up, they have a tendency to adjust things higher. As we're going down, they're going to project things lower. It's just more human nature that way. And just to kind of show you, on March 25th, this is where we were. We were setting new highs at this time, and some of these outfits thought we were still going to go higher. Well, way down here, I couldn't put, all I wanted to do is put the low range at 4,200 on the bottom. Well, 5,600, we haven't gotten there yet. So there's a line there. You just can't see it. But some of these were projecting that we were going to go up from there, down from there. Well, we did end up falling, and then we're bouncing up out of that. And then as of May 20th, way down here, this is JP Morgan, and a lot of these folks are still looking a little more positive with their outlooks. So what I do when I see these things, I read them, I try to take in what they're saying, and I say, okay, does that line up with what I'm seeing in the charts here? And if it does, okay, that confirms what I'm seeing. If it doesn't, I'm like, okay, I think I'll reach my own conclusion, which may be different than the conclusion that they reach. Here's our intraday chart where we did gap lower all the way down to S1, but then we bounced up off of that. That set the low right at the open. We came up above the unchanged level in the daily pivot, and we just kind of danced along. We dropped below the daily pivot, a little bit above and below the unchanged level. And then this is rather encouraging because it was later in the day when we broke above the daily pivot, came back down to the daily pivot. And then as we were getting set to close, that's when we shot up to R1 and we closed at R1. So not at the high, but very near the high for the session, even though it was a 0.25% advance. Intraday chart, just seeing a lot of sideways action over the last few days as the market has really quieted down. We're still seeing an improvement here intraday. The blue line is still above the red line as growth has been outperforming value. Also seeing a bit of an improvement here with S&P growth of value intraday. Where growth was up for the large caps, it was up, but up a lot less with the value for the large caps. It was down less for the mid caps and up barely where small cap value ended up being down. So we're seeing a little bit of an improvement, but we're still going down with our ratio here with the small caps. We're also going down still with the ratio with the mid caps, and we actually showed a little bit of an improvement, but not an awful lot of conviction, at least yet, with S&P growth of value on the end of day chart. This is showing some improvement here between the two ETFs. We're starting to break up outside of the rainbow where we had been more stuck inside the rainbow. The fact that we're peaking out is showing an improvement there, but not seeing anything really, in fact, just a tick down between discretionary and staples with this other area that we watch. Large cap growth coming back, setting another all-time high. The Wilshire not necessarily setting an all-time closing high. It could be really close, but looking solid. This is a broad market measure. Our trend is starting to strengthen a bit where we have the ADX above the moving average. That suggests a strengthening trend. We're also above 20. That confirms that we are in a trending environment. The green line, even though it declined, is still on top. So it's a developing positive trend. Short term, kind of seeing pretty much that same thing here. Volume just continues to drop off and off and off. And that is a concern as we've been going up and up and up with the S&P. We're kind of going more or less sideways right now, but to see volume tapering off, that's a classical negative divergence that we want to be aware of. Sentiment, we're getting really low readings again with the Ulcer Index. We don't have an updated chart from Investors Intelligence. They're just slightly extreme positive. And we're dropping with the VIX. We dropped below this line here at 13 with the line chart as well as the bar chart. And we're ticking down just a little bit where we had been seeing the VIX of the VIX, showing the volatility of the VIX starting to pick up a little bit. It did fall in Tuesday's session. The momentum of the VIX continues to be down. My gosh, we're under 12 again, 11.86 for the VIX. And I couldn't update these. They weren't updated by the time I was getting ready to record. And we could be getting kind of close to an extreme reading with the 5-period chart, but we don't know that yet. Volatility risk premium picking back up just a little bit, but we're still at the lower end of this band, suggesting the volatility remains low. This fear gauge ticked down just a little bit. Our other fear gauge also is, that's really hard to see. I think it ticked up just slightly there. And this is a newer chart that I included in yesterday's video where I have some inverted charts here. Here's the S&P on top, setting recent all-time highs. And this is a chart that I usually show in the weekly video. This is the option adjusted spread between risky and not as risky bonds. Usually we watch this as it's going down. We're flipping it around so that it will line up more with the price chart. And we're just seeing that there's not a lot of fear in the bond market right now when you measure using the spread. We're also seeing the VIX, which is inverted as well. Usually we would look at it as it's going down. To match it up on this chart, I'm actually inverting that one. And it's also showing that there's just not a lot of fear. We're doing okay with the advanced decline line based on price. We declined slightly and we're flat based on volume. The new highs, we are still looking pretty healthy here. We're starting to see our 5 period begin to roll over. And it's not because of an expansion of new lows. It's that we're seeing a trailing off of new highs here. But we're still going up and starting to flatten out a bit with the 10-day average. We came down just a little bit, but we're still positive with the advanced decline ratio. Accumulation distribution. This is supposed to be a smart money indicator, and it's also taking volume into its calculation. This is looking pretty good, and we're above now an advancing moving average. The chicken money flow did pull back just a little bit, but the moving average is still going up. Another smart money indicator. The chicken oscillator just barely ticked back up, but it's still positive. The cumulative advanced decline line for the NYSE did decline slightly, and we're flattening out with our regular advanced decline line for the NYSE, also going sideways with this other NYSE advanced decline line. Coming down just a little bit with the NYSE common stock based on price, and still going up a little bit with the advanced decline line based on volume. That could be a positive divergence if we see volume holding up better than price. But these ticks are so small right now, it's really hard to read much into them. When we look at the cumulative price for the S&P, we're just kind of topping out right now, but still looking okay, I guess, based on volume, but no real big moves here. We're still holding up with the advanced decline line studies, even though we're declining a little bit here with the small caps. All the indexes that we follow are still above their moving averages, and their moving averages are still trending up. Maybe not as much for the small caps. Short-term chart, not really seeing anything as far as support or resistance right now based on this chart. We do have some pivot points above current price if we get to that level, but my gosh, we're looking at the high 43s to even 50, the high 54s to the 5,300 levels here. If we start to pull back, we'll be watching this pivot level, and we'll also be watching the 50-day moving average. Volume continues to be below average. The Stochc RSI is still extreme positive, as is the Williams percent R, the CCI 14, and the CCI 20, even though they've been pulling back slightly. The stochastics in the short, intermediate, and long term continue to be extreme positive. We're still extreme positive with the boom indicator. We're still kind of far away from the 20-period moving average, and we're just under the reading of being extreme when we measure the distance from the 50-period moving average. The 200-period moving average is still looking positive. We're looking okay here with our double and triple exponential moving average based on 20 periods, but we're starting to come back in between these lines. And we're starting to come down. This is some of the weakness that I'm starting to see. We're declining with the 20, 50, and the 200. This is calculated on the price of the S&P itself. These are not stocks inside of the S&P. Now, some of this could be because we've been running up, and as these higher prices come into the calculation, that's going to possibly turn this over. The force index was not really all that much changed, and it's still positive. We want to watch the 20-period simple and exponential moving average just to see if that ends up providing support. If we decline, we're still up in the +3 standard deviations channel. That's extreme. Intermediate term, we're looking a little bit extreme here with the balance of power. The go, no go is positive. The highest high value is also positive. The TTM squeeze is extreme positive. And longer term, just to give you some perspective, we're above this black line, but for right now, it looks like it's still going up. The 50-period double and triple exponential moving averages. This is showing some improvement here. We're above both of the lines, If we could see the red line cross above the blue line, that would show that we're moving up with more conviction. The CMB composite continues to be extreme positive. 50-period moving average, just want to keep an eye on that, but we're well above it for the time being. We're going up with the ease of movement and above zero. That's positive. The Arun is flat, but still positive. This is where we're seeing some potential weakness. The S&P McClellan oscillator is declining. It's still positive, but it's coming down. So our summation index based on price and volume, but you see how this solid move up is just starting to roll over just a little bit. Now it could change. We just want to be aware of this for right now. Also seeing a bit of a decline with the NYSE McClellan oscillator here, but we're still above zero. So we're still going up based on price and volume. We're not really seeing much of a rollover here, at least yet. This is another warning sign. The Swenlin trading oscillator continues to decline based on price and volume, but both are still above zero. A little potential area of weakness that could be developing, but the momentum is still looking good. The PMO is going up. We're also going up based on price and volume, but we're starting to come down with the PMOs that are rising. We're flattening out with the buy signals, but we continue to go up with the PMOs that are above zero. Another little potential warning sign here. We continue to be neutral with the Elder's Impulse system for the S&P. We're still positive with the parabolic SAR. We're still looking positive with the slope oscillator. It had been rolling over a little bit. Now it's turning back up, but it could be considered extreme positive. The MACD is still looking pretty solid though. So in the short, intermediate, and long term, we're still positive with momentum. We're still looking good here with our moving average studies. We're above all of these moving averages that are plotted here, and some of the shorter term lines are starting to cross above the longer term ones. The bullish percent index is still looking pretty good right now and not giving us an extreme reading. That happens when it goes above 70. And we're just kind of going a little bit sideways here with the NYSE bullish percent index, and we're still going up with the NASDAQ 100 bullish percent index. So this is still looking good here. The money flow index just starting to give us an extreme positive reading. The ultimate oscillator turned back up. That's still positive. The vortex is starting to get extreme positive. And the RSI 14, it's not extreme yet. We're still extreme with the RSI 9. The on-balance volume continues to look positive. And we're starting to come down a bit with our 20-period moving average study of those stocks in the S&P. Could this be a potential sign of weakness? Just something to be aware of. And we're also coming down with our study after we had the big thrust up here, and we've been seeing the S&P go up. Yeah, it's common. Even when we had this other thrust a little over a year ago, we still saw pullbacks during that time. But you take the bigger picture look at this, and the S&P was quite positive. We also declined slightly with our 50-period moving average study and our 100-period moving average study, as well as the 200-period moving average study. Just a little bit of potential weakness. The Copic curve is still positive. The Sean trend meter is pretty much flat and still extreme positive. Still working off of a Pring bottom fisher signal that was generated in the end of April. The MES index, not sure what to do with this. We're just going down, down, down. If something doesn't happen in the next day or two, I'm probably going to stop showing this chart. We're still looking good on a trending basis with the Heiken Ashi, the Kagi chart, the Renko chart, and the 3-line break chart. We're still looking positive here with the 150 and 200, even though they are rolling over slightly. We're positive across the board with the Keller market model. We're also positive with bonds based on price, still negative in the intermediate and long term. Commodities are in an uptrend in the short term, where the dollar continues to be in a short-term downtrend. And they finally made this change might have been over the weekend, where the decision point scorecard has us positive with both of their models in the short term and intermediate term. We're still mixed in the long term. Here are the alerts that were triggered. We had the industrial BPI cross below 70, and the materials also crossed below 70. Canada, hey, oh, Canada, setting a new all-time high. The NASDAQ closed above 16.8 and then set an all-time high there. Here's our sectors, seeing utilities still doing strong. This is another defensive area that we've been watching. Discretionary had a fairly good day, but staples were also up. That's another area. And I have a couple more charts to show you later on. We're going to keep an eye on healthcare. The big three for defensive are utilities, staples, and healthcare, because these are things that people have to have, even if the economy is really suffering. And a lot of times folks will be getting into these areas when they're starting to turn more defensive. We could also put energy into that mix as well. It's been kind of a defensive strategy over the last couple of years. So we'll just be keeping an eye on these. The equal weight versus the S&P, not really seeing much of a difference other than we did see the mega caps outperforming, but we're just chopping around here. We've just been range bound for 2024. The Dow is still holding up for right now. This is an area we're seeing some weakness, the Dow to transports. The Dow's been going up, the transports are now going down, and I haven't shown these charts in the daily video in a while. You can see here's the transports all by themselves. They were down, what was that, 1.67%. It's a pretty significant decline. We want to see this going up to turn more positive. And looking at the ratio between the transports and the S&P, we're just pretty much falling off a cliff as the S&P has been outperforming. The diamonds continue to be neutral with the Elder's Impulse system. The NASDAQ still looking good here, setting a new all-time high. NASDAQ 100 looking pretty good. The QQQs remain neutral for the Elder's Impulse system. The momentum for the NASDAQ 100 is still positive. We're starting to cross above this moving average, so this is turning more positive with the Qs. Small caps, yeah, we got up into the high end of this range, so what do? We start going down. And we remain neutral with the Elder's Impulse system for the small caps. We're still looking okay with the RSI. We're above 50, and we're not getting an extreme reading. We're above the 50-day moving average. The momentum still continues to be positive. The mid caps staying above this pivot point right now, even though they were down slightly. The mid caps remain neutral for the Elder's Impulse system. Apple is above its 200-day moving average. The 50 is starting to turn back up, but it's still in a downtrend. Tesla also above its 50-day moving average, but also in a downtrend. That should be did I say 200-day moving average for Apple and 50-period moving average for Tesla? NVIDIA, this is what a lot of folks are waiting for to see. Are we going to see one of these big moves up like we've seen in the past? Microsoft also looking pretty solid right now. Meta kind of fell back almost 1%, still under its 50-day moving average, but still in an uptrend. Amazon also coming back down to its 50-day moving average. Google setting all-time highs. And Netflix also not all-time highs, but breaking out a little bit here. The FANG index is setting a new all-time high. Financial sector was up, still looking pretty solid there. We want to keep an eye on the staples to tech ratio. This is ticking back up slightly. We're not seeing really any conviction right now as the market's really slowed down. The dollar was up slightly and still in a longer-term uptrend, at least based on how I look at it. Looking at the S&P versus world stocks, seeing a pretty strong correlation based on 10 periods and a little bit of a turn up with the longer-term correlation. Also looking at this ratio, when this is going up, that just means the SPY, which is the S&P 500, is outperforming the world stocks ETF that we look at. The staples, they were up again, and this is another area that's been causing a little concern. Utilities also looking good, not an all-time high, but they just keep hanging in there for now. This is another area that we want to watch. We're watching healthcare, which is in an uptrend. So this is another defensive area. And energy, which lately has been more of a defensive area. This is also in an uptrend as well. We just want to watch these things. The total US stock ETF, yeah, looking pretty good. And when we look at the 10-year, we were down slightly with the 10-year yield, and we were up slightly with the 10-year based on price. We're still going down with the 3 to 7 year bonds versus stocks. So that's showing more improvement. We want that ratio to go down. When we look at the broad market, we are showing where it's outperforming shorter term bonds. Another broad market measure is also performing a little further out bonds. The Qs are still outperforming 3 to 7 year bonds, and the tech sector is outperforming 3 to 7 year bonds. We're still favoring a soft landing, according to what the market is anticipating. And when we look at cash versus 3 to 7 year bonds, we're ticking back down slightly. This ratio is still in a longer term uptrend. We want to see this really fall, and it's not really doing that with any conviction, at least yet. Seeing that same type of thing when we look at 1 to 3 year bonds and compare them with 3 to 7 year bonds, we want to come down and actually fall below the rainbow. We're also ticking down a little bit here with tips with 7 to 10 year bonds. We want to see this continue to really fall. And then looking at our possible positive scenarios, the growth to value ratios, a little bit of an improvement with Qs to the S&P, still underperforming with discretionary, and showing a little bit of a tick up when we compare large cap growth with large cap value. So the large caps are improving. We're back down to a declining moving average with the mid caps and turned down, but still above the moving average that is declining with the small caps. We're still looking good with our 10-day average of the S&P 500 highs minus the lows. We're coming down just a little bit with our 19-day moving average study of the advanced decline ratio. This is a little bit of weakness that could be coming in. We're still going down with the S&P to utilities ratio. We want this to go up, but it's just that utilities are doing so well right now. And we're coming back up with our staples to S&P 500 ratio. We want to see this continue to decline. So what's our outlook for Wednesday? NVIDIA will be reporting earnings after the close on Wednesday. We're positive, but we're still extreme positive. Are we starting to see some potential areas of weakness? Nothing that can't be fixed with a good solid update. But if this starts to build on something and start to be confirmed in other charts, that might give us some concern. We're going to get the MBNA mortgage applications index, existing home sales, and then the FOMC meeting minutes at 2 p.m. Eastern. We want to keep an eye on all the crazy stuff going on these days, and there's a lot of crazy to go around. We're going to get weekly jobless claims on Thursday, and then durable goods and consumer sentiment on Friday. And I think I said Fed Chair Powell. That should have been, she's not the chair of the Fed anymore. You know, the lady with the angelic voice who's now the Treasury Secretary. Apparently she gave some kind of a talk, but it didn't seem to impact the markets. And this is what's happening on Wednesday, and then what they're thinking existing home sales will be. Seasonality, we're neutral to negative with the S&P and NASDAQ, where we're just flat out negative with the Dow. So we're not looking really good from a seasonal basis. We do see a little bit of positive seasonality with the green dashed line during an election year, but Wednesday is the most negative day of the week based on what happened in 2023. This is trying to look at the sitting president running. If you take out 2020, it's like if you take out enough stuff, you can get a chart to say whatever you want. The green line it's a day or two outdated now, but this is what we've been doing with the S&P, where we're following the yellow line to see if we can track that more with a seasonal tracking. Tom Bowley still has us in the more negative part of the month of May. Warning signs, the mass index, I'm not sure what to think of that right now. To me, it's becoming more and more irrelevant. You need to have these triggers, and there's not a real hard and fast rule. I know there are some, like with the ZWAG NYSE Brett Thrust, you have to have another confirmation signal within 10 days. With the Hindenburg Omen, there has to be another confirmation within 20 trading days. I just kind of do this by, okay, let's look at the overall climate, and it just doesn't look like it's happening, at least yet. The S&P, and we're watching that as it's making at or near all-time highs. We're watching staples and utilities, which is a warning sign, and we're going to be watching energy and healthcare as well to see if they are showing any real strength. That could be another setup in a defensive posture. Growth to value as well as discretionary to staples, they're not, I mean, they're doing okay. They're not falling apart, but they're not really showing any strength either. And we were wondering, is some weakness starting to come into the market right now? Just a speculation at this point based on what we see. And I don't know about the equity put call ratio, but then all these other positive things that we're looking at that I've gone through on the charts, just to give you a list of everything that's looking good for right now. So our conclusion, we're positive. We're still extreme positive. Are we starting to see some weakness, especially in the short term, which could also be bleeding over into the intermediate term, but we're still positive in the long term. But we are extreme positive with the 150 and 200 period moving averages. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.